Good morning and welcome to Bloomberg UK. I'm Tom McKenzie in London. On the show this week, Paris in the spotlight after Brexit, our exclusive interview with the Bank of America chairman and CEO Brian Moynihan, live from the lender's Global Investor Summit in the French capital. Also on the programme, flickers of life appear to be returning to the UK housing market. We'll discuss the latest survey from the Royal Institution of Chartered Surveyors. Plus, our interview with dovish policymaker at the Bank of England, Swati Dhingra, who says more rate rises could damage a weak UK economy. Let's return then to a story we've been covering this morning. Bank of America is hosting its first Global Investor Summit in Paris. The French capital's finance sector has seen huge growth in recent years following the UK's exit from the European Union. Let's get to Bloomberg's Francine Lacqua, who is at the summit along with a guest. Francine.
Tom, thank you so much. We've had some great guests so far. We spoke to the Apollo Chief Executive Officer. We spoke about NATO and Ukraine with the former Croatian president. And now we're joined really by our host today. He's Brian Moynihan, and he's the Chief Executive Officer of Bank of America. Brian, first of all, thank you so much. You're putting on a great conference. And you're here in Paris because you were really one of the first Wall Street banks to say, look, in this Brexit world, this post-Brexit world, I want to choose Paris. Is this being vindicated?
I'm not sure what vindication would be. So post-Brexit, we looked around, and this was a place that we put our broker-dealer, our securities operations for Europe. And we've gone up 10 times the number of people we had in 2019, and that's a relatively short time frame. And we're very happy here. It works well. Vanessa Holtz and the team run it under Bernie Menz's leadership, and they do a great job. And more importantly, thank you for joining us today. It's a great conference, and we're glad to have you here to help us spread the word and get the ideas that come out of it out to the market. So
in this post-Brexit world, how do you see actually servicing your clients in Europe, and how do you see the animosity that maybe the two sides are getting closer in these Brexit negotiations?
Well, the Brexit negotiations are going to have a lot more to do than financial services, but our strategy from the beginning was to get operational, get our clients used to the fact that they're going to, what they call face off in the markets against different entities, get those entities stood up and put together. So we have a UK broker-dealer, and our bank is branched in the UK, and then we have our Ireland subsidiary and the French subsidiary, a bank and a broker-dealer. So you had to get ready to go. And so it'll work out over time, and we've been around for 200 plus years, so whatever rules, as long as they settle in, we can operate. But it was disruptive at the time, and it's going to have implications to how capital raising works in a market that wasn't completely unified yet. Even the promise of the Europe to get to combined capital markets and the uniform capital markets was still in front of us, and now you split two major pieces. So we feel good about what we've done. It would have been easier if we didn't have to do it, but that's not our choice, and now we continue to adjust.
Brian, how many times a day do you get asked about U.S. inflation and the Fed?
Probably more than we should, because the U.S. has this big, huge economy which goes and moves along. And so, if you think about our team at Bank of America's research team, which is one of the best in the world, if not the best in the world, under Candace Browning-Platt and her leadership team, they basically have a recession predicted beginning in the third quarter this year, third, fourth, and first quarter. But it's a slight recession. It goes down 1% or 2% and then moves back up, and then gets back to 1.5% growth in the latter part of next year, but still below trend growth. And so the Fed has to cut off the inflation, and they're clear about that. And you had Chair Powell testify for 2 days, so I'm not going to illuminate anything.
And the markets were all over the place on the back of that.
It will be, because they're all trying to figure out. But remember, the big move was 0 to where we are now. Yeah. We have 75 basis points more to 5.25, 5.5. But the big move is where we are now, and that is still soaking through the economy. So the most interest rate sensitive pieces of the economy impacted quickly. Housing, mortgage originations for banks down, other types of financing down. The capital markets adjusting caused the leverage finance and capital markets to close, and now they're opening back up, and that's good that you're getting some stability. But that's the intended outcome: sucking liquidity out of the system, bank deposits going down, especially after the massive stimulus. That's what they're intending to do, and it's happening. Now the question is, how long do you have to wait against a good consumer and employment and things like that?
But are you surprised at how resilient the U.S. economy was? And I remember, 7, 8 months ago, a lot of the chief executives, also of Wall Street banks, saying, look, there's going to be a tornado. It's going to be a really tough economy for the consumer. And actually, we have not seen them. Were they wrong, or is it just going to be delayed?
Well, it's going to be delayed. It has been delayed, so that's a fact. But the question is, if you look at the American consumer in February, so we track are all the consumers and how they spend money, and that's $4 trillion plus a year. So it's not a small sample. And if you look at what happened in February, it increased over January's rate of year-over-year growth. It's now, for year to date, it's up to about 8.5%. February is higher than that, or up to 8%. In February is about 8.5 to 9%. That means the consumer's accelerating again. And so the first thing is the consumer spending across all dimensions. Now, they've moved to services away from goods. The travel experiences, luxury hotel bookings are up a little bit more than regular hotel bookings. You can see all the activities. If you go to the other side of the track, do they have money in their accounts? If you look, high-end consumers, businesses move their money into the direct holding of securities, the wealth management customers, because that's what they do. But if you look at the mass, the general consumers we have, their account balances are still elevated multiples where they were pre-pandemic. And the spending them down, which is a big worry, they're going down. In fact, in February, they rose a little over January. There's always some seasonality.
So you're confident. Actually, that the numbers you're looking at
they're in
are
good
strong.
shape. Yeah, they're in good shape. Now, that makes the Fed's job tougher, and that's the dialogue you have about how you can slow it down. But it all comes back to unemployment. Unemployment's low. Wage increases are still pretty strong. And you don't see that. New claims for unemployment, we'll see what happens this week. But each week it's hovering at a level. It's very low, and there's some seasonality debate, but it's still very low if you thought you were really in a recessionary environment.
And what's the market reaction function been like?
Well, it's been, when rates went up, obviously the adjustment and the marks, and last year was not a good year for equities or fixed income, which is very unusual. But if you think about it, the markets then have settled in, and you start to see a little bit of life in the capital markets. The pipelines are full. You saw some deals get through, and that's good news. And yet it's still not close to where it was when it was due, when it was in like 21 and early 22. But on the other hand, it's stabilizing. And so, yes, there's trading volatility every day, and yes, everything moves around. But the reality is a long-term thing is settling into place that says the Fed's, it has to move rates up and has to keep them there longer. That's the piece I think Chair Powell's been trying to make people here over the last 6 months have been, we're going to have to hold them there longer to ensure that we've done the job, even if they don't go as high as people think or a little bit higher than people think. They got to hold them there longer.
Because do markets understand that? And actually, if you see yield back in fixed income, how does that change the whole asset class?
What's interesting, our economists have a rate decrease in March of next year, 24. Interesting enough, people forget that in 19 the Fed cut rates. This Fed cut rates when the economy was slowing down. So the question of when they come down the other side is interesting. But our economists, who are a very talented group, believe that they cut rates because it basically will have won the war on inflation, and then they'll bring it down. Because it's an inverted rate curve is not the normal experience, and they want to get to a real rate curve, but not necessarily an inverted one.
You're one of the only Wall Street banks not cutting jobs. Why?
Well, we have a phrase that we've used for many, many years, let attrition be our friend. And so with a 200,000 plus people, you have a normal turnover rate. It's starting to go down to an all-time low again. So we're running about 12% across the whole base. Going in the pandemic, dropped to 6%, worked its way back up, and now it's back down in the mid-single digit, which is terrific. A great place for teammates to work, doing a great job. The reality is you can manage that head count. And so we'll redeploy people across the franchise, including investment bankers, to other parts of the franchise to help us in the middle market investment banking. So you can move it. Our head count peaked in January. It's down a few thousand. It can move, but you had to stop hiring, and that's what we had to do last fall.
What do you spend most of your time on? Is it a strategy in China? Is it, I don't know if it's fintech or ChatGPT.
Well, I spend all my time asking questions about all that because, I've got these talented teammates that drive the company. So, all the issues at the moment, how ChatGPT will affect. We have this thing called Erica, which is a virtual artificial intelligence, virtual assistant, natural language processing, predictive technology that we've been running for 4 or 5 years, and 18 million customers use it. 150 million times a quarter. So we're used to it. But this is now a new one that could change the game. And so we're trying to figure it out.
Do you think it will? I mean, at the moment, you're not allowing it, are you?
Well,
are you using ChatGPT?
We aren't allowing it. That's more of a technical sort of security question and how it works and things. The use of artificial intelligence and predictive technology and stuff, we use not only on the consumer side, but we use that same technology internally. But it runs on our data in an environment we can understand. It doesn't have the exfiltration problem and stuff like that. So it's a great thing. That'll all work out over time. There'll be licenses and brought internal and work on your own data and then bring data into your things. And that's just working through the security things. That's the issue of letting a bunch of teammates go out in the public environment, start potentially pulling our data into the public environment without them understanding it.
All right, but so it will morph into some form that you'll be using basically internal in some way.
Some
right.
form of these. We already use it. That's what I'm saying. Artificial intelligence, we went to Stanford to say, give us a natural language processor for financial services. We built the artificial intelligence, worked on the data. We have the insights from the customers. You think about it. You could be driving down a road in a car at 60 miles an hour and talk to our mobile app, and it could go to 110 systems and find a specific transaction and tell you what it was. That's pretty amazing, but it takes the technology, the pipes to distribute the data array and accurate, and it's pretty wild. But that's still out in front of us.
Also sounds pretty stressful if you're on the wrong side of the trade. Talk to me about China. What's your reopening strategy, or what's your strategy in China given their reopening?
Well, across the world, we basically do two businesses: corporate investment banking, large companies, and capital markets. And Hong Kong is a major place for us, and we have in China itself. And we're continuing to support the companies that both multinationals doing business in China and very large Chinese companies. That's the business strategy we have. We haven't changed that. The atmosphere around it is obviously completely different than it might have been 5 years ago, but and that's something you deal with in the ebbs and flows of the world. But right now, it's just keep your risk where you want it, keep your operations in good shape, and make sure you understand what's going on.
But how do you look at the regulatory questions, or actually what China wants to do with financial services?
There's a lot of negotiations that are going to go on between our two countries over time here, and just like Brexit, when a set of rules become understood, we can do it. Right now, there's a set of rules that we operate within, and it's fine. But you wish it wasn't as difficult in some of these countries because of the geopolitics, but that's the reality of being in a business which basically works to reflect the economies of the countries around the world and helps clients prosper in them, and that's the nature of it. So we're there, but on the other hand, it's a little trickier being there than it was 5 or 6 years ago just because of the environment.
What are you most hopeful about in the next 12 months? I mean, we talked about the Inflation Reduction Act. I mean, there's so much actually going on news-wise. What do you see as a positive?
I think what I'm hopeful about is when you see all these companies that we work with, whether it's the Sustainable Markets Initiative under King Charles' leadership, or whether it's the work we do at the World Economic Forum, or whether it's the work we do in the Business Roundtable in the U.S., or you see all these companies who understand fully that they've got to deliver for society and deliver for the shareholder and driving the changes, whether it's on the environment or other issues. And, doing it from a fundamentalistic capitalistic basis, that the capital can be redeployed. And charity doesn't earn a return. I mean, it's psychographic and impact, but the reality is, once you give away the money,
this is real
capitalism
money
has to solve it. And so we did, in the sustainable finance area generally, we've done $430 billion in a couple of years. Our 10-year program for $1.5 trillion. We're averaging 200+ billion a year. Environments, 230 of that. And our customers are making the change. Each day I get up and I get a feed of stories and stuff all about all the deals that went on in the environment space. It's amazing what's going on, driven by the private sector. And that's what gives me huge confidence, not only the next 12 months beyond, is the private sector is leading this, which means it has stick to the ribs quality.
Brian Moynihan, thank you so much for joining us today. And thank you again for a conference. We'll have plenty more, of course, from the conference. We also have a former French president coming up, Tom, so we'll bring you that interview shortly. And this is Bloomberg.
Okay, Bloomberg's Francine Lacqua, of course, at the Bank of America Global Investor Summit in Paris. Now, still ahead from that summit, an exclusive interview with the former US House of Representatives Speaker Paul Ryan. That's at 10:30 a.m. London time, 5:30 a.m. if you're in New York. Coming up, UK property surveyors say flickers of life are returning to the UK housing market. We get the details. This is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Tom Mackenzie in London. Now, the UK property surveyors say there are now flickers of life in the housing market as both buyers and sellers return to the market in February. The Royal Institution of Chartered Surveyors, RICS, says prices fell again, but its more forward-looking survey pointed to signs of improvement. Let's bring in Tarrant Parsons then, senior economist at the Royal Institution of Chartered Surveyors. Tarrant, thank you and good morning. Thank you for joining us this morning. Where is the relative resilience then in an environment, of course, of houses and households under pressure, the cost of living crisis, higher mortgage rates, but there seems to be, and this is what the survey points out, relative resilience within the UK housing market. What are the supporting factors?
Yeah, I would kind of caveat that with saying trends across the UK housing market are still quite downbeat in terms of the overall picture being reported for activity. But just last month, we saw our indicators on buyer demand and sales volumes, albeit they're still weak. They did move off of the lows that were seen right at the end of the last year. What I think has happened is we saw a very sharp adjustment following the spike in mortgage rates in October. Financial markets have settled somewhat since then, and mortgage rates have come back slightly. They're still much higher than 12 months ago, but the real drop off in activity came at the end of last year. Still weak now, but recovering maybe slightly.
So where does that leave the RICS view on house prices if you look out a further 6 to 12 months? How much more downside is there across the pricing of housing?
Well, looking at our data and its kind of track record for leading upcoming changes in the official house price index, I think a reasonable projection at this stage would be to say that prices could be down by somewhere in the region of 10% year on year. That's at the national level in 6 months' time. I think the fact that our price indicator didn't really sink any deeper into negative territory this month may even suggest that the decline might not be quite as steep as that. But then again, I think the situation is very fluid. It's very difficult to give a precise forecast when there's so much uncertainty around the outlook for the economy and for interest rates. So that 10% fall seems a sensible estimate at this stage for me.
OK, 10% year on year as the fall for house prices. Before we let you go, Tarrant, a view then from what to expect from the budget. It is, of course, next week, March the 15th. What do you and the team at RICS want to see from this government to support the housing sector?
Any support for kind of house building or retrofitting is always going to be welcome. I know house prices are falling right now, but there is a real, that's because of the mortgage rate increase, there's a real kind of supply shortfall, especially if you look at the rental market. So tenant demand is still very strong. That's pushing rents higher, and both, home ownership is very costly. Rental prices are very costly as well and rising sharply still. So delivering more units is going to be critical if you really want to make the UK housing market more accessible longer term.
OK, Tarrant Parsons, Senior Economist at the Royal Institution of Chartered Surveyors. RICS, thank you very much indeed in what is needed from that budget that, of course, is coming up next week and the state of the UK housing market. Now, coming up, the BOE, the Bank of England in the balance. We dissect some of the diverging views, and they are diverging, from the rate setting committee this week. That is next. This is Bloomberg.
Was right, but I was also basing my views on the research that indicated that front-loaded policy would be a superior strategy to achieve the equilibrium. But on the other hand, we have to remember just how strong the external forces of inflation are or have been. And so, although I'm vindicated, I also recognize that the external forces were going to be there anyway.
OK, the Bank of England's Catherine Mann there speaking to Francine earlier this week about the need for tighter monetary policy. After these hawkish comments, the BOE's more dovish MPC member, Swati Dhingra, has warned against further interest rate rises, saying it could damage a weak UK economy. Our UK correspondent Lizzie Burden joins us now and has been speaking to Swati Dhingra. What did she have to say on this panel? Arguably one of the most interesting members of the MPC at this point.
Indeed, Tom. And we've got you covered here on Bloomberg. We've got the Hawks and the Doves. Swati Dhingra came out with her first speech since joining the Monetary Policy Committee yesterday. As you know, she's already voted to hold rates twice. She suggested that she would do the same again at the meeting coming up this month. And the reason is, she says that over-tightening risks denting the economy. The difference between her and Catherine Mann is she says the Hawks are too focused on domestically driven inflation. Take a listen to this.
Wage inflation is really a measure of the distribution of the losses from trade. It is not a measure of average losses from trade. And as a Monetary Policy Committee member, we are not It is not our job to be able to take any kind of judgment on how the losses should be divided across the population.
So look, Swati Dhingra is the trade expert of the committee. What she says is that most of our inflation is actually imported, and she also emphasises the lag in monetary transmission. So she says the previous jumbo hikes have still yet to fully take hold, and that chimes with some of even the hawks, formerly of the committee, who we've been speaking to. So Michael Saunders told us on Bloomberg Radio that even he would ease the pace of hikes to 25 basis points, and Andy Haldane, the former chief economist, says that he would move cautiously from here.
So the dividing lines are quite clear, though, between the hawks and the doves. How does that set us up for the meeting? It's 2 weeks away.
Yeah, well, it's interesting that you've had the ECB and the Fed making some hawkish noises. You saw at one point yesterday traders pricing for a peak of 5% in the key rate for the Bank of England. I put this to Swati Dhingra because it's interesting, isn't it, that the UK sits in the middle of the Venn diagram between the US's tight labour market and Europe's energy crisis. You would think, perhaps, that the UK should double down and be even more hawkish. Well, her argument is that there are differences even between France and Germany. The US is more consumer-driven, and actually, she's not as worried about a further drop in the pound as Catherine Mann told us she was. Take a listen.
So how worried as a first order should I be about the exchange rate? I think not as much as I should be about some of the other factors.
And the reason for Dhingra is because when she looks at the imports, most of them are not priced in dollars. So this goes some way to explaining how you can have such a split on the committee, members looking at the same data but reaching different conclusions. And what it means for the next meeting is it's going to come down to the men, because they're sandwiched between the external female members at the different ends of the spectrum.
Well, that's a shame, isn't it? We would hope we moved on for that. But the debate is real. It's significant, of course, for the UK economy. Thank you very much indeed, Lizzie Bird. And the pound, of course, maybe arguably from Swati Dhingra's perspective, a softer pound isn't that terrible when it comes to the inflation picture. Credit Suisse tumbling 5% as they withhold their annual report on the SEC questions. Stay with us. This is Bloomberg.